So let's look at some of the key trends from the last quarter. So starting with consumer financial health. So consumer financial health remains overall fairly positive amidst tough economic environment, right? We see high inflation and a looming recession. We look at several metrics to assess the financial health of consumers. So we start with spending. So spending continues to remain healthy. Holiday spending was also slightly better than expected. Card balances have been rising. They're normalizing to just the pre-pandemic levels. Even revolving balances are also rising, but they're not exceeding any pre-pandemic levels. So balances are also in a decent place. When it comes to credit quality, it remains overall healthy. We are starting to see slight delinquencies among certain lower credit quality segments, though. And when it comes to consumer confidence, it has been at a historic low over the past few quarters, but we are seeing it rising again. So that's some consolation. And finally, in terms of unemployment, despite all the news about layoffs in the technology sector, when you look at unemployment trends from an overall industry perspective, they are at a historical low. So when you look at all of these consumer financial health metrics, you might wonder if there is a recession coming. So what banks are anticipating is that a recession will hit in second half of the year, but they're not expecting it to be a severe one. Moving to credit cards. So overall, we're seeing a healthy growth in sales across most issuers. And this growth is driven by both discretionary spend, which is goods and services, as well as non-discretionary spends, which would be travel and entertainment, right? However, we're starting to see the rate of growth in sales slow down a little bit, but it is still continuing even into 2023. And as discussed earlier, we're seeing growth in balances as well as revolving balances amongst different issuers. And in terms of new card acquisitions, it has been a very strong story over the past couple of years, right? Over 33 million new accounts were added in 2022, and major credit card issuers reported a double-digit year-over-year growth in card accounts in Q4, which is very strong. And then when we talk about the demand trends for different credit card categories, we're seeing a decline in demand for travel and rewards cards in Q4, right? Although this is still higher year over year, and this is likely a function of returning to pre-pandemic seasonality, right? And then what we're seeing in balance transfer is as the balances are increasing, there has been an increase in the balance transfer demand as well. And this can be expected to rise in 2023 as customer balances and revolving balances continue to rise. When it comes to deposits, we're seeing a couple of different trends. One is overall decline in balances year over year. Although they're still 30% higher than pre-pandemic levels, but year over year, they've gone down. And the second thing is when we talk about interest-bearing deposit accounts, we saw an interesting thing. We saw the traditional banks' balances decline in the last year, whereas online banks saw an 11% increase in balances. So this is primarily driven because of the online banks offering significantly more attractive interest rates than the traditional banks. So if consumers had moved their savings into higher yielding accounts, they would have earned $42 billion more in interest. So they're leaving a lot of money on the table. And there are a few reasons why this is happening. One is many accounts have low balances. So it might not be worth the effort for a lot of customers to open new accounts for a little bit of savings. And the second is also there is a certain amount of inertia related to opening a new account, right? So for marketers, it is important to advertise not just the rates, but also the ease of new account opening to attract new customers. Now moving to lending, we'll start with personal loans. So personal loans is seeing a strong growth in originations. So in Q4, SoFi reported 50% growth in originations year over year. Wells Fargo reported 19% growth in originations. Discover also reported around 14% increase in balances year over year. And what we're also seeing is return to normal seasonality, which is pre-pandemic seasonality for personal loans in 2022. 2018, 2019, we had certain seasonality, and we didn't have that seasonality during the pandemic or in 2021. And in 2022, we're seeing that seasonality come again, although it is at a slightly higher magnitude. However, when it comes to other consumer lending businesses, they have been negatively impacted by macroeconomic conditions as well as regulatory factors. So for mortgage, both purchase and refinance are down, but refinance is worst impacted, around 87% decline in originations year over year, which is massive, right? Um, and when it comes to auto loans, some auto loan lenders like Capital One have decided to pull back on auto loans. And this is in response to competitive pricing dynamics, which have put pressures on industry margins overall, right? So they don't want to play the price game at this point, so they are pulling back. And talking about student loans, so federal student loan borrowers are awaiting the moratorium on student loan payments. So they're not refinancing right now, right? Which is resulting in a significant decline in refinance originations. So SoFi reported that their originations were down 73% year over year, which is massive. Now let's talk about investment and wealth management trends. And this has been a similar story for the past few quarters. The assets under management have been declining, primarily due to lower market valuations. However, it has been partially offset by positive momentum in net inflows, and both from existing customers as well as new customers. Another interesting trend in financial services has been the rise of the Gen Z segment. So, Gen Z is becoming a more dominant segment overall. There are more adult Gen Zers than adolescents now for the first time. And also, they're about half the size of the millennial population. And they're fast becoming customers of financial services. However, their behavior is more unique than some of the other cohorts, and financial services firms need to understand them better to effectively acquire them. So, one is that they use social media more, which is expected, but they also seek financial advice on social media, both from brands as well as influencers. They are digital natives, but also look for human support. They're a key growth segment for BNPL products. Currently, around 22 million Gen Zers are users of BNPL products, and this number is expected to go up to 35 million by 2026. And they're also willing to pay for premium products and services. So Amex has focused on millennials and Gen Z segments, and they've seen very strong results. So they have been the drivers for growth for Amex cards over the last few quarters. Around 60% of the new proprietary card acquisitions have been in this segment, and 70% of those have been for fee-based products. So those were the key insights from the last quarter. We can expect 2023 to be very dynamic with a lot of changes in the macroeconomic conditions as well as customer behavior. We will continue to keep a close watch and keep you apprised. Please reach out to us if you have any questions. Thank you.